Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. We have a great show for you today, an information-packed show discussing many of the trends that are happening in the markets. Been getting a lot of questions, as you do often at the start of every year. A lot of individual investors wanting to put some more money to work in things such as RSPs, tax-free savings accounts, and just money in general into the market. I guess we came off another great year last year, and the month of January has been pretty good. As we say, as goes January, goes the rest of the year. We talked about that on our shows in January called the January Barometer. And the S&P 500 was up about just over 1%. And that bodes well for the rest of the year. So here are our topics for our show this afternoon. Canadian GDP appears to have stalled in November. We're going to talk a lot about that. I had the privilege of being on CP24 last week when the Bank of Canada announced their interest rate decision. They decided, as we all now know, to hold interest rates. And I'm going to talk about Canadian GDP and why I think that is a mistake and why Bank of Canada, in my opinion, should be cutting rates, not to mention the federal government perhaps cutting taxes. Top 3 things to consider over the next 5 to 10 business days, our very popular segment of a list of 3 ideas that individual investors need to be focusing on before you make your investment selection. Gold and silver settle back down after a dramatic run. I've had a lot of questions on gold and silver. A lot of actually the last couple of shows we've talked about gold and silver. We're going to talk about that as well today. And we're going to talk about whether gold has more room to fall, whether silver has more room to fall. I know coming on air today, both of those things were actually slightly higher. S&P flirts with the 7,000 point mark. Should we expect the markets to continue to move higher throughout the year? What kind of year are we expecting? What should our expectations be? We've seen a lot of individual analysts and investors weigh in with different numbers for the upcoming year. Some of them a lot higher and some of them not as high. RSP deadline is fast approaching. March 2nd this year, first 60 days. March 1st is a Sunday. That's why the March 2nd deadline comes out on a Monday this year. Should you be investing in RSPs if you need a tax deduction? Well, the answer is obviously yes. Quick hits. 3 things that I've noticed in the news that many of you have noticed as well, I'm sure, and I'm going to comment on those. And last but not least, your questions. If you have a question during the show, please put it in the chat boxes and my team will pick up those questions. And I hope to be able to answer those questions for you at the end of this show. And if not at the end of this show, hopefully we can get to them on our next show. So without further ado, let's move forward with our show. Canadian GDP, as I mentioned, I had the privilege of being on CP24 last Wednesday. If any of you watching today or tuned in to CP24, you would have seen me at around 10 a.m. and commenting on the latest interest rate decision by the Bank of Canada. As we all know, there was no move. The Bank of Canada said basically in their statement that things were the same as the last meeting. Nothing really changed much. The same fears existed with respect to trade, the negotiations, the uncertainties, the unknowns. They were still present. And however, jobs numbers were okay. And they thought that things were good enough to remain on hold. And coincidentally, the Federal Reserve remained on hold as well. However, we now know who the next Federal Reserve chairman will be. And Kevin Warsh, we'll talk a bit about him later in the show. But it looks like the president has chosen a new chairman to hopefully be in the position to cut interest rates a couple of times at the very least by the end of 2026. Well, will the Bank of Canada follow suit? And I'm just not so sure they will. And the interesting thing is, when we talk about GDP and, we talk about interest rate decisions, And we're going to see in a second, we can actually pull up our first chart of GDP, and you can see it right there. One of the things I honed in on with respect to the Bank of Canada's rate decision was his comment about things were basically the same since the last meeting. Well, if you look at this chart and you see how many red bars there are in the last 10 years, you're going to notice that in the last 10 months, I should say, not 10 years, 10 months, the last 7 months out of the last 10 months are all red. Is this an economy that is firing on all cylinders? Is this an economy that is doing well? The answer to me is simply no. We're barely growing. I think the Bank of Canada says we're growing just over 1%. Is that good enough for the Bank of Canada? Is that good enough for our federal government? Is that good enough for all of us? Since when does mediocrity become acceptable? Oh, well, things are just okay. Well, that's great. Do we want it to just be okay? Why isn't the Bank of Canada continuing to cut rates to stimulate our economy? And for that matter, why isn't our federal government thinking about, mentioning, talking about cutting taxes right across the board to stimulate this economy, put more money in the hands of all of us, of investors, of businesses, so that we can borrow, we can grow our businesses, we can have more money in our hands so we can go spend it in the economy, buy big ticket items, go to the malls, go to the stores and purchase things so we can better ourselves, better our lives. I just don't understand how we continue to accept mediocrity. And this chart clearly shows it. And if you go back even further, you could take in the last 13 months, what do you have? Maybe 5 out of 13 months show a positive number in GDP. We're just barely getting by. You know, a famous economist, David Rosenberg, said recently in a CTV News interview that he thinks the Canadian economy is in a recession, that manufacturing is down, housing is down. You know, what other indicators does the Bank of Canada need before they take an aggressive stance and continue to cut rates? David Rosenberg thinks they're going to have to cut interest rates further this year. I'm hearing by some that maybe the next interest rate movement could be higher. Maybe next year interest rates move higher, not lower. I just don't understand, and it is quite frustrating, especially when you look at our neighbors to the south. I actually call them our competitors to the south now. Once upon a time, we shipped down to the US about 80% of what we took out of the ground and build here in our country, Canada, and the US took it in, used it, accepted it. But now we know that is not the case. We know that there are tariffs. We know that there's a negotiation going on, that Canada is probably going to have to give up a bunch of things just to be able to trade with our largest trading partner. So I look at the United States as a competitor. So if that is the case, why would business come to this country versus the United States? What advantage do we offer? What benefit do we offer? I just don't see a benefit right now. In the US, yes, their inflation rate is slightly higher, closer to 3%, but they're growing at almost 5% GDP, and they're considering cutting interest rates. They have a president who continues to do things such as cutting taxes, no tax on tips, no tax on overtime, introduces a bill to cut taxes, keep the current tax, status quo, tax rate status quo, but then do a few extra things to give people a break. What are we doing here in our country? How or why would business come here? Our premier has said $28 billion of new business came into Ontario. We heard that on our last show, Premier Ford. Imagine if we cut taxes. Imagine if we cut interest rates further. How much easier would it be for the premier to bring more business, more foreign investment to our country? I just don't understand what the Bank of Canada is looking at. And I agree with David Rosenberg. I think a 1% growth rate is unacceptable, and mediocrity is just unacceptable. Let's go to our second chart we have, which shows the Bank of Canada and our last interest rate movements. You can see January, no movement. December, no movement. We had, quarter point cuts in October, September, but prior to that, in the summer, again, no interest rate cuts. So are they going to cut this year? You know, when you look at all those red bars that we saw, that coincides with the last 10 months. So that would take us, up till, in the spring of last year. And I just think that the Bank of Canada needs to be much, much more aggressive. Our last chart for this segment talks a bit about what I mentioned is taxes, tax rates. And there you have it. I'm a big proponent of cutting taxes, not 1%. When the prime minister came into power, I think he cut 1% tax, off the top, and and he used that as a selling feature. What is 1%? I don't even know how much that gets the average individual in this country, how much further ahead it gets people. I'd probably say not much at all. Look at these tax rates with our biggest, not neighbor, but our biggest competitor right now for new business. Look at marginal tax rates. If you look at these tax rates, you will see on $150,000 of income, average tax rate in our country, 43.5%. In the United States, 29%. What is that? It's a 14% difference, almost 15% difference. And if you look at the highest tax bracket in our country, you're looking at a 53% tax rate. So the CRA, the Canada, makes more money off individuals at the highest rate than we actually make, or individuals make for themselves. And look at the United States, 37%. And I hear out of the US that they're barking about that. They're complaining that their tax rates are too high. And here we are, 16% higher. How can we continue to be competitive? This is the question that I ask every day. The good news is a lot of people feel the same. I know TD Economics has agreed that back in the fall, they would have loved to have seen a tax cut. I've had a number of individuals on our show talking about tax cuts in the past. I will continue to push for cuts. I continue to talk to the Premier about it. He agrees that we need to see something from the federal government. And the hope, and my hope, is that the Bank of Canada will consider cutting interest rates. Because right now, we can clearly see that GDP in this growth is stalling. We're obviously not in a recession, but by no means is that a reason not to continue to stimulate. In my opinion, mediocrity is not acceptable no matter where you're at. And for some reason in Canada, we seem to be okay with it. So hopefully, some point this year, we're going to get some more aggressive stimulation by the central bank. And maybe, just maybe, at one point, the Prime Minister will consider cutting taxes as well. Now the part of the show where I list 3 things that I think individual investors need to be focusing on before they make their investment decisions. A very popular part of the show. I get questions on this list all the time. Earnings season with big tech taking center stage. Yes, we are in the midst of big tech earnings. We just had earnings from a big tech name, not a Mag 7 name, but AMD reported earnings after the bell last night. And boy, is it getting hit hard this morning. We'll touch a bit about why that is, but we're going to get 2 big earnings from Alphabet, Google, as we all know it, and we're going to get earnings from Amazon, all within the next 24, 48 hours. And that goes along with the earnings that we've already received last week from the likes of Meta, Microsoft, Apple, Tesla, all those Mag 7 stocks. Number 2, number 2 idea as part of our list to focus on for individual investors. Most market gains are concentrated in a few places. And we're kind of used to this because for the longest time, we said all the gains are coming from the Mag 7 stocks. Well, not anymore. They're coming from other areas of tech. And a lot of people think that maybe these are too stretched, overblown. And maybe, just maybe, that's why people are still talking about this whole idea of a bubble bursting. But, I'm going to talk about why that is not the case. Software is not one of the hot areas of the market. And I think it's important to talk about software stocks. We saw Microsoft report earnings. Yes, Microsoft is a very diversified company, but of course, also software. But we're seeing software stocks, software as a service. That's what they offer. Names that I'm going to show you that are really taking it on the chin. And some of those names for no reason. So another thing to focus on if you are an investor. So let's move to our first topic, earnings season, and big tech takes center stage. And I still get this call for, Allan, are we in a tech bubble? I still hear about the tech bubble. And Maybe it's just because the media is always a little bit behind in things. Maybe the retail investor in general is always zigging when everybody else is zagging on the institutional side, or on the the savvy or the smart money is moving one way, and the retail investor is moving another. I'm not so sure, but I still get the odd question about a bubble. And well, let's show you our first chart, Magnificent Seven Index. We can put it up here. Well, does that look like the chart of a stock or a bunch of stocks that are in a bubble? You could make the argument that these stocks have gone nowhere since the end of September. They've been pretty much up and down a little bit in a trading range for quite some time. Now, there's been one Magnificent Seven stock that has done extremely well, and they're going to report earnings shortly. And that is our next chart, which is of Alphabet. And it's funny because Alphabet was a stock that was left for dead. Many people said, oh, search is going to be eaten up by software, by Chat GPT. No one's going to do Google searches anymore. Well, guess what? They have Gemini. Alphabet has Gemini. Gemini 3, when it came out, it proved to be, for many, better than whatever Chat GPT had. I think Chat GPT called it a code red. OpenAI called it a code red, whereby they needed to go back to the drawing board and improve Chat GPT to compete against Google's Gemini. And so here we have it, where Alphabet comes out with Gemini 3.0. It turns out to be fantastic, and Alphabet has gone up ever since and really doing extremely, extremely well. But they've been pretty much the only Mag 7 name that has done well. We'll see what their earnings are. But if you look at our next chart, Amazon, again, going back to this idea of a bubble. Well, where's the bubble? Has Amazon done much in the last year? I don't see it. It's been choppiness at best. It's been hovering around 235, 240, maybe gets below 225. It really hasn't done an awful lot. Our next chart, this is the one I mentioned a little earlier, AMD. AMD reported earnings last night. Fantastic earnings. Beat on the top and bottom line. And on top of that, took up their expectations for this upcoming year, took up their expectations right across the board. Guess what? Their stock is down $40 a share, or about 17% when we came on air this afternoon. Why is this happening? Well, perhaps it's because AMD was riding a pretty strong wave, as you can see on the right-hand side of that chart. It kind of went up quite a bit into the print, or into the numbers last night. Or perhaps people are just getting tired of the Mag 7 names or big cap tech names. And yes, AMD is a big cap tech name now. It used to be a small tech name. Now it's much, much larger. AMD, for those of you that don't know, they make chips for gaming. They make chips for really AI, and that's CPUs, GPUs. That's what AMD does. And it's just interesting. Again, people talk about this tech bubble. Well, I don't see it in AMD. And in fact, the more people talk about a tech bubble and expect something to burst, the more unlikely a tech bubble will burst, because a lot of these big cap tech names are not doing that well, but in terms of share price. But they're all doing well with respect to earnings, top and bottom line, whether it's a Meta. Microsoft last week reported great earnings. And because their cloud growth, which was their Azure, it was expected to grow about 40%. Well, guess what? Microsoft came in with growth rates of about 38%, 2% below what they were expecting. Stock sold off. $357 billion came off the market cap of Microsoft. Is that justified? I don't think so. Stock is down over 20% from its highs. Perhaps that's a name you want to take a look at some point. So corporate earnings season, the focus is on big tech, and the focus will continue to be on big tech and over the next couple of days with Amazon and Alphabet reporting. Our second topic to focus on, if you're an investor making some decisions over the next couple of weeks, is this idea of market gains are concentrated in just a few areas. What are these areas, you wonder? If they're not the Mag 7, what are these areas? Well, here they are. Number one, storage. We have a few storage companies to tell you about. Our first chart is one of SanDisk. What do you need storage for? Well, you have all these data centers, all this AI, all this information. It's got to be stored somewhere in the cloud or wherever. That's where names like SanDisk come in. Look at that chart. Unbelievable. At one time this year, and this year is only what, 5 weeks old? SanDisk was up over 1,000% in the last month or two. It's been an unbelievable ride for owners of SanDisk. Another name that we have a chart on, Seagate, also storage. Seagate, an amazing run. There you have Seagate's run. Unbelievable. What else has been a hot area? Memory. Why do you need memory? Well, everything needs memory, right? Memory for servers, memory for computers. You need memory. What companies do memory? SK Hynix out of South Korea, and the number one memory company here in North America, Micron. We have a chart on Micron. There you have it. Now, coming on air, Micron was having a bit of a rough day. Stock actually is below $400 a share now. It's been on a tremendous run. Memory prices have just skyrocketed, making it very difficult for computer companies to cope. Names like Dell, Apple, and others stumbling a little bit because the memory chips that go into a lot of these products are now so high. The prices are so high that it's eating away, obviously, at profitability. Last but definitely not least, the third area that is hot is chip equipment makers. These are the companies that make the equipment that produces the chips that we need to go into everything. Our chart here, and we've talked about this stock before, Lam Research. Let's take a look. There's Lam. Unbelievable. But you can also take a look at Applied Materials, ASML. These companies are just through the roof. ASML, European company. Applied Materials, another US company. So these are the hot areas. Well, I showed you the hot areas. What is not so hot? The darling name that we've come to love over the last few years. Let's take a look at NVIDIA. Is NVIDIA in a bubble? Is it a hot area? Well, to me, that's not the stock or the chart of a hot stock. We also, again, have a one-year chart on Amazon. We can put that up. Amazon reporting earnings after the bell. And NVIDIA, I think, reports in a few weeks. So these are pretty hot areas that we've talked about. A couple of not so hot areas. Actually, we have one more not so hot name, which I've already mentioned, and that is Microsoft. Let's show a chart on Microsoft. If you're an owner of Microsoft, oh boy, you've been in the doldrums, and for a little while now, Microsoft hasn't done much in over a year, maybe even a couple of calendar years. So hot areas, you got to know where they are. Should you be buying into them? I probably would tell you no, maybe on a dip. Maybe you want to look at some of these areas that have sold off. And speaking of selling off, our third topic for these list of 3 things that individual investors need to focus on, software, and in particular, the sell-off of software stocks. Software stocks have been the darling for this market for so many years, and all of a sudden, AI has come along, and now people are saying maybe AI and the products coming out of companies like Anthropic and their Claude or ChatGPT or Grok or whoever else, these AI companies are going to produce things, plugins that will replace some of the, offerings by these big cap software names. And so we're seeing a massive sell-off in software. First chart clearly shows the sell-off in software stocks. Here you have it. It's the pink line. And if you, relate it to the S&P 500, which is the gray line, you can see the massive sell-off. Some of the earnings we're seeing starting to slow down in some of the software companies. That's our next chart. You can see it here. But I just think that we're grouping, or investors are grouping, many of the software names all together. And the earnings slowdown that we're seeing is not happening in all software companies, but yet all software companies are being thrown in. Even cybersecurity names like Palo Alto and CrowdStrike, these names are down. They're being looked at like software companies, and they are far from it. So does that present buying opportunities for us? Perhaps, and perhaps something that individual investors need to be looking at. We have a few charts on some software names before we leave this topic. Our first one is ServiceNow, a great company, has pretty much all the Fortune 500 companies as customers. Look at how much that stock has fallen. Another very well-known software name, Salesforce. This is your CRM system. They also are involved in marketing and a bunch of other initiatives for businesses. They use AI in their suite of products that they offer. but I just don't think they're being replaced by AI, because you look at their earnings, they've been fantastic. And the same for ServiceNow as well. Take a look at CRM or Salesforce having a really difficult time. The one software name that I've actually exited out of is our next chart, which is Adobe. I do believe Adobe is in tough, and I also do believe that AI can do many of the things that Adobe offers. So that's a name that wanted to show the chart. That's a name that I'm just not too excited about. But overall, I just think the sell-off in software stocks has been overblown. So again, looking at our top three things, right? You want to look at, tech stocks this earnings season. We still have a couple of big tech names to go. You want to look at where the hot areas of this market are. Don't think that it's still the Mag 7. Don't believe that the bubble still exists in a lot of these big cap tech names. I just don't see it. And you want to be mindful of software. Maybe it represents a good buying opportunity. And with that, before you make your investment decisions, I think you need to focus on those three things. So gold and silver definitely have settled back down. I know a lot of people were calling for gold and silver to have a bit of a sell-off, and we saw it. And I have a problem with those that call gold a safe haven, silver a safe haven. Yes, it's a hedge against the US dollar, perhaps US economy and strength in the US, but by no means, when you look at silver falling 30% in a day, gold falling over 10% in a day, is that really a safe haven? I think people, when they say safe haven, they think of reduced volatility. And by no means do these materials offer a safe haven or less volatility. In fact, I think they offer more volatility. They just act perhaps as a safe haven against the US dollar. But volatility is definitely there. And we have a couple of charts that will show the volatility on gold first. Here, let's pull up our first chart. There you have it. It is a chart over the last, let's call it 6 months. You see the run up there all the way to past 5,500. I know gold was flat today. It's trading in and around 5,000. It actually dropped from 5,500 all the way to 4,700 in a very short period of time. We have a 3-month chart, or actually a 1-month chart of gold. We can put that up, and that clearly shows that a huge sell-off of gold. It shows that above 5,250. I will tell you it got above 5,500. And a sell-off, and now it's trading in and around 5,000. A lot of people asking me about silver. You see, silver has usage, more usage than gold. It is used in manufacturing. It is used in solar. It is used in offering different technology. It is used there. So it does have usage. It does have industrial usage. But gold doesn't have much usage at all other than jewelry. So people have been talking about silver. Well, here's a chart of silver. It's had a tremendous run. I remember when silver was $30, $40, and it got above $100 at one point. But you see on the far right-hand side, and let's pull up a chart, our next chart, which is a 1-month chart of silver. Look at that decline, a more than 30% decline in 1 day. So what's the bottom line with silver and gold? Should you consider buying it? Well, yes. The U.S. is struggling with debt levels. They're struggling with the idea that they're not paying off their debt. And the whole Western world, I think, has the same problems. The Fed looks to cut rates this year at some point. So take down interest rates, which will affect the US dollar, bring that down further. So is it possible we could see higher levels for gold, for silver, for pretty much anything priced in US dollars? The answer is yes. But as a bull on the US dollar over the long term and the US economy, the US markets, I find it very hard to own gold. Yes, you may want to own gold as a part of a diversified portfolio, but to be a true hedge, you're going to need to own 40% in gold, in silver. And I just don't think anybody is equipped to do that from a risk standpoint, from a volatility standpoint. So as part of a diversified portfolio, yes, you want to own some of this, but no more than that. I still would not consider it a core part of any portfolio. S&P 500 flirts with the 7,000 mark. It actually crossed the 7,000 mark in January. It has since pulled back, and it seems to be pushing up against 7,000, then it pulls back, and then it pushes up against 7,000, then it pulls back again. Well, what do we expect for this year? And as many of you know, I've said this on our telecast before, and I've talked to people about this in conversation on TV as well, radio. I think it's going to be more of a quote unquote average year. I think the markets are going to give us an opportunity to make money, 8 to 10, maybe 8 to 12% growth. By no means do I think that the market is going to give us another 20% year like we've seen over the last few years. Last year, a little less, in around 16% on the S&P 500. The TSX was over 30% growth. I just don't think that gold and silver is going to move up as much on the TSX. I don't think Canadian bank stocks are going to move as high. They've had a tremendous run. I think they're going to have to take a bit of a breather before they move to the next level higher. So for me, realistic expectations is so important for your portfolios. I think if we come in and we don't lose back some of the gains that we've made the last few years, and we can actually increase our returns a little bit more than the market offers, I think that would be a win-win for all of us. First chart that we have here is on the S&P 500, and you can see how well the S&P 500 has done over the past year. Yeah, a lot of ups and downs, but for the most part, the S&P has done really well, and it's really important to notice the ups and downs. You know, I'm sure I'm going to get a few questions in the next few days if the market pulls back a little bit in February, which it may after a positive January. You know, is this the beginnings of a big pullback or a big letdown? You know, the answer to that really simply is I just don't know. We know on average markets pull back 5 to 10% a few times every year. Every year the S&P 500 has a 5 to 10% fall, at least once, twice, maybe even 3 times. Last year, we saw a 20% decline on the S&P 500 last spring, only to see the market rally and see the S&P produce returns of about 15, 16%. So we can't just get caught up in the noise. The markets are falling. Oh my goodness, is this the start of something bigger? Well, the fact that people are aware that it could be something bigger and are on alert, that just means the big fall isn't going to happen. It's when we don't expect it to happen. That's when it catches us all off guard, and we have this spiral of selling, and selling creates more selling, and then you get the big sell-offs. But if we're all nervous about a sell-off, it's usually not gonna happen, at least a big one anyways. Our next chart here talks about expectations from different individuals and or different individual firms. You can see here, Oppenheimer has the biggest target, 8,100. Capital Economics comes in at 8,000 along with Deutsche Bank. Then you have Morgan Stanley, Wells Fargo, Citigroup coming in at 7,700. As you get down further, you're looking at Goldman Sachs in at around 7,600. And you get to the bottom, which is Bank of America, 7,100, and Ned Davis Research, 7,100. So they're not thinking, or they're thinking that the gains will be very muted this year. I believe that you're going to see more gains than that. I'm more in that 10% area. So if we came in and around 7,000, you're probably looking at 7,700, 7,800 by the end of the year. That would be my expectation for this year as an investor. Our third chart and last chart for this segment really just shows the averages over the last many years. The S&P 500 in and around 10.5%, as I mentioned earlier. Toronto Stock Exchange in and around 8%. The last few years, that has we've seen returns a little bit higher, so that average is probably a little bit higher, maybe 8 to 10%. Let's call it in that range. But nevertheless, S&P 500 has always had a better move higher over the last decade. Only the last year or so has proven to be where the TSX has outperformed. So keep a reasonable expectation. I think that is so important. And, expectations or managing expectations is what individual investment advisors focus on most. And as long as investors have the right expectation, then the message hopefully is not misunderstood. RSP deadline fast approaching, as I mentioned earlier in the show, March 2nd, not March 1st, because March 1st is a Sunday this year, March 2nd, first 60 days. That is when all investors, or that's the date that all investors have to contribute by if you want a tax deduction for your 2025 income tax year. Let's put up our one chart for this segment to show you what the numbers look like. So how to calculate what you can put into your RSP if you've maxed out your RSP in previous years. 18% of 2024 income will give you your 2025 limit. And if you're contributing to your RSP, and you can do that right now as well for your 2026 income, if you know what that's going to be, then it's 18% of your 2025 income year. There are obviously maximums that the government puts. For 2025, $32,490 is the maximum if you're fortunate enough to be able to put the max. And this year, for 2026, the maximum will be $33,810. And if you're wondering how it's figured out or calculated, how much it goes up, it's obviously based on the inflation rate or inflation. If inflation got up quite a bit, you would see these numbers move significantly higher. Tax-free savings accounts, something I believe everybody should have. If you don't have a tax-free savings account today, call me. Let's get a tax-free savings account open for you. It is a way that you can invest and not pay any taxes on the gains. Yes, it is true. You do not get a tax deduction for your contribution, but you get to put away money and allow it to grow tax-free for really as long as you want until you take out the money. We know in the last couple of years, the maximum that you could put in any given year went up by 7,000 last year, this year, for example. So now the cumulative limit for TFSA contribution per person, if you were 18 years of age as of 2009, is 109,000. So if you have a spouse, you and your spouse can put in up to $218,000 and grow that money tax-free. A very powerful account. I always say to people, what's the difference between RSP and TFSA? If you need a tax deduction, you got to go with the RSP. If you don't need a tax deduction but want to invest, then maybe the RSP doesn't make sense, because when you pull money out of the RSP down the road, you're going to have to pay income tax. Whereas TFSA, you can grow your money tax-free, and when you pull it out, you pay no tax. Any capital gains or dividends or interest or anything while in a tax-free savings account, you pay no tax. So a great way to invest for your future, and that is the difference between the two. But keep in mind, March 2nd this year is the deadline for first 60-day contributions to your RSP. Quick hits. These are three things that I've noticed in the news as of late. I'm sure many of you will recognize some of them. And as always, I want to comment just briefly on each. Number one, seeking shelter from Trump's fury. U.S. trade partners reach deals with each other. They're reaching deals with each other and other parts of the world. Look at Canada. Our prime minister going off to Asia and Europe, trying to make some new deals. We're going to comment on that. Trump's choice of Warsh to lead Fed could reshape the world's most influential central bank. Kevin Warsh will be the chairman, the new chairman of the Federal Reserve in the U.S. What does that mean? Well, he's coming in with a new set of eyes, a fresh set of eyes. But again, keep in mind, he is only one vote, and there are others, obviously, on the other voting members that will vote at these meetings. So one vote won't sway all the different Federal Reserve governors. It may. Obviously, he carries a big stick. The chairman does. Number three, post-holiday reordering boosts U.S. manufacturing in January. We saw manufacturing numbers actually go higher above the 50-point mark, which means they're actually increasing. We're not seeing decrease. We're actually seeing increasing for the first time in a long while. So let's move to our first quick hit. We know that with the tariffs coming into play on really every country across the planet has tariffs on goods that they ship to the U.S. This has forced many countries to start looking at trade negotiations with each other. U.S. major trading partners have started to look at China, have started to look at other countries within Europe, Canada, etc., to make deals. Our first chart for this quick hit and only chart shows you Canada change in year-to-date exports. There you have it. Look how low, or look how much U.S. exports have fallen in the last, let's call it last year. And with the rest of the world, it continues to increase. And if I didn't know better, I would say that the U.S. should start to get a little concerned. And maybe they are starting to be a little bit concerned with that, because I'm sure if you look at a chart for the UK and a chart for other European countries and Asian countries, I think you're going to find that this pattern is happening in many of, or with many of the trading partners of the US. Our next quick hit is President Trump's choice for Kevin Warsh to run the Federal Reserve. And we know from Kevin, Mr. Warsh, that he hasn't been happy with the Federal Reserve. He thinks that things need to change. He's looking at their balance sheet. He thinks it needs to get a lot better, a lot stronger. And we've seen many headlines, and let's pull up some of the headlines that we've read about and seen. Here you have the markets are set to test Warsh. He's going to have to appease the markets, perhaps, or try to do what's right for interest rate policy and his dual mandate of full employment and stable pricing, at the same time as not getting in the bad books of the president. Keep in mind, remember, President Trump actually elected Jerome Powell. And here we are so many years later, and he's calling him stupid and not fit for the job and too slow Powell and all the different names he's been calling him. And, you know, when you look back, he actually elected him. So hopefully Kevin Warsh doesn't, it doesn't happen to him what happened to Chairman Powell. Fed chair nominees, Warsh may want smaller Fed holdings, but that's not easy to do. That's another headline. And former Trump economic official Gary Cohn says Kevin Warsh will take the Fed back to traditional norms. So a lot of Wall Street people like this. A lot of Federal Reserve officials like the choice. Kevin Warsh was a Federal Reserve official. He's also worked on Wall Street. I think he has the best balance of both. And the hope is that he will do the right thing. Fed independence will remain. And I think the market likes this decision. Our third quick hit and last one talks about this idea of post-holiday manufacturing. The reordering boosts manufacturing, and we've seen the boost in the US. Let's pull up our chart for this. You can see for the first time, there it is, 52.1. Anything above 50 shows expansion. And you can see for really since 2023, we've seen very little expansion in manufacturing. And for the first time, we're seeing a number above 50. Does this have anything to do with the President Trump's policies, his administration's policies? Maybe, I don't know, maybe bringing back manufacturing to the United States because of his tariffs. Does that have anything to do with this number? I guess that will remain to be seen. But it looks like for the first time, we are seeing in, I guess, a few years, manufacturing back into the United States and back positive for the United States. What's my take? This is the part of the show where I get to take a question from our audience, and I'm actually going to go off the charts a little bit today. It's a question I've been getting from a lot of individual investors, and I touched on it briefly during the show, and I say off the charts a little bit because I have a number of questions here that I could get to, and I'm going to try and answer those throughout the next 2 weeks and maybe in our next show. But I wanted to touch on this main question that I've been getting from investors, and that's, you know, what is what we're seeing now, the bumpiness, the choppiness in the markets, is that going to lead to a bigger market decline? And, you know, the best way for me to answer this question is this. As sure as I'm sitting here talking to all of you today, the markets are going to go down at some point. There's no doubt about that. Will they go down 5%, 10%, or will we see a bear market of 20%? I just don't know. But what I can tell you is the declines in the market are short. They're for brief periods of time. The decline is very sharp. As I say always, the market takes the elevator on the way down. But the good news is the ups are longer and for longer. The ups, or the market may take the stairs on the way up, which means slowly, but the good times last a lot longer than the negative times. If we do see a pullback, or I should say when we see a pullback, at some point this year. Let's not panic. Let's look at it as opportunity. You want to take profit when the market is rising, not when the market is falling. That's when you actually look for some bargains. And as I said earlier on the show, software has been falling tremendously. I think there are some bargains there right now. Maybe not every software stock is something that you should be owning, but I think there's a case to be made for some of them. I think as the market does frequently, it kind of throws everything into that software basket and sells everything. It's not very selective. It's, shoot first, ask questions later mentality. And that's what the market does. So when you do see a pullback in the market, don't panic. We know over time markets go up. And I believe, talking a lot about President Trump this show, I believe that 3 years from now, when President Trump leaves the White House, I do believe the market will be higher. Not so much because of what Trump says from time to time, but I believe the pro-growth policies that the administration has taken on will continue to improve the U.S. economy. Now, here in Canada, we may not like it because, unfortunately, it goes against what we're trying to do. But the U.S. economy, U.S. jobs, U.S. growth, we're already seeing it, 4 or 5%, will do just fine. So let's not panic. Let's stay the course, and let's continue to buy good quality names at low prices. So with that, I want to say thank you to everybody who tuned in to our show this afternoon. I hope you were able to take something important from the show, an idea, a statistic, or something that you could take away and use it when you develop or create your portfolios. 2 weeks from now, we have a fantastic show that will be on Wednesday, February the 18th. We have Flavio Volpe. He is president of the Automotive Parts Manufacturers Association. He's going to talk to us all things automotive. What's going on with automobiles, cars? Is the car manufacturing really going back to the United States? And, whether it's Michigan, Indiana, wherever it's going, what's going on with automobiles and how is that going to affect the steel industry? How's that going to affect jobs, especially in Southern Ontario? So we're going to have that interview for you and much, much more across all social media platforms. And it promises to be a fantastic show. Again, February 18th at 12 noon, as always. And until then, happy investing.